Good morning. Welcome back to another episode on marginal costing. This marginal costing, this is a topic on cost accounting, tools and techniques of cost accounting. Is useful for the undergraduate students. And in this particular marginal costing second part, uh, I'll be solving a problem on marginal costing. So let us understand the problem which is given to you where the details are given with respect to Ramakrishna Company Limited. The sales value is 1,20,000, variable cost is 60,000, and fixed cost is 30,000. These are three things are given. Based on this, you are required to calculate. There are five sub questions. One is the PV ratio, profit volume ratio. Next is BEP, break even point, and margin of safety. Second sub question is you need to calculate the sales to earn a profit of 1 lakh rupees. And the third one, the profit when sales of 4 lakh rupees. And the next one is what is the effect of break even point if there is an increase of sales by 10%. And the lastly, what is the effect on break even point if the sales value decreased by 10%. This is a simple question. So when a question is given with respect to the sales, variable cost, fixed cost, first and foremost prepare a small statement called marginal cost statement. This statement consists of, take the sales minus variable cost, sales minus variable cost is called contribution. If we deduct the fixed cost, you will get profit. So this is a simple statement which gives the foundation for the further calculations. In the problem, the sales given as 1,20,000 and variable cost is given as 60,000. Therefore, 120 minus 60 contribution is 60,000 rupees. From this contribution, deduct the fixed cost given in the question, that is 30,000. Therefore, the profit is 30,000 rupees. So these are the fundamental values in which we need for further process. Come to the first question is called profit volume ratio. Profit volume ratio, the formula being is contribution divided by sales into 100. Either this contribution can be taken either in terms of amount or in terms of per unit. So either may be the per unit or may be the amount. The ratio in which you are going to arrive, it's the same. So the another formula for PV ratio is contribution per unit divided by selling price per unit. This formula is to be applied only when if the details pertaining to the selling price per unit and variable cost per unit if it is given. Third formula to be applied when sales and profit is given, profit or loss. If only the sales and the profit is given, if variable cost and fixed cost is not given, then you need to follow the third formula. As far as this first, our present question is concerned, the sales and variable cost is given, so we need to go for the first formula. So to calculate the PV ratio, as the formula being is contribution divided by sales into 100, you know that the sales is given as 1,20,000, variable cost is given as 60,000, therefore the contribution is 60, and you have deducted the fixed cost, therefore there is a profit of 30,000 rupees. By substituting these values in the formula, contribution divided by sales into 100, contribution you have derived as 60,000 divided by sales, it was given as 1,20,000 multiplied by 100, you will get a PV ratio of 50%. So this is how you need to calculate PV ratio. This 50% can be expressed as 0.5 also. Next is you need to calculate break-even point. It is the point at which company neither derives the profit nor incurs the losses. It's a point of no profit and no loss, where the revenue is equivalent to the cost. So how to calculate the break-even point for this question? The simple formula is fixed cost divided by PV ratio. Already you have calculated as the PV ratio as 50%. So substitute the value as fixed cost divided by PV ratio. You know that the fixed cost is 30,000 rupees, that was given in the question, and PV ratio you have calculated as 50%. Therefore, substituting 30,000 divided by 50%, you will get the break-even point as 60,000. Whenever you are using the formula as PV ratio, fixed cost divided by PV ratio, now break-even point is in terms of amount, that is amount break-even sales volume, break-even point in rupees. That's what you need to remember. If fixed cost break-even point equals to fixed cost divided by contribution per unit, then it will be break-even point in units. Therefore, in this question, break-even point in rupees equals to 60,000 rupees. Third sub question is called you need to calculate margin of safety, where margin of safety equals to actual sales minus break-even sales. Actual sales you have calculated as 1,20,000 rupees. Break-even sales just now you have calculated as 60,000. Therefore, 120 minus 60, you will get 60,000 rupees as margin of safety. One more formula can be followed or applied for calculation of margin of safety also. That is profit divided by PV ratio. Margin of safety equals to profit divided by PV ratio. In our problem, we have calculated that the profit is 30,000. Sales minus variable cost contribution, contribution minus fixed cost is profit. Profit was 30,000 rupees. PV ratio we have calculated as 50%. If you substitute the values, you will get the same answer as 60,000 rupees. Therefore, you can use either actual sales minus break-even sales or profit over PV ratio. This profit over PV ratio normally we use when margin of safety is to be calculated for a given level of profit. That's the third sub question. Next is you need to calculate the sales volume when the profit was 1 lakh rupees. Sales to earn a profit of 1 lakh rupees. If the profit is 1 lakh rupees, what would be the sales? That is to be calculated. To calculate this, the simple procedure here is sales equals to fixed cost plus desired profit divided by PV ratio. This is the formula. So, you know that this PV ratio you have calculated 50%. You know this fixed cost was 30,000 rupees, that remains unchanged, and profit what exactly you want is 1 lakh. If profit is 1 lakh, what is the amount of sales to be made? Substitute these values as fixed cost is 30,000 plus desired profit is 1 lakh divided by PV ratio is 50%. Therefore, 1,30,000 divided by 50%, you will get the sales volume as 2,60,000 rupees. This is what the total amount of sales wherein you are going to get when you want a profit of 1 lakh. Another way of calculation of the profit when sales is given. The second thing is you need to calculate the profit. There is a reverse for the previous question. You need to calculate the profit when the sales is 4 lakhs. If sales is 4 lakh rupees, what is the amount of profit in which you are going to get? The same formula can be used. That is the sales equals to fixed cost plus desired profit divided by PV ratio. And by substituting these values, your present sales volume is 4 lakhs. And fixed cost remains the same is 30,000, PV ratio is 50%. So, when the sales is 4 lakh rupees, sales equals to 4 lakh rupees, fixed cost plus profit in which you are going to calculate, let us assume it is X divided by 50%. On cross multiplication, you will get 30,000 plus X equals to 4 lakhs into 50%. This 4 lakhs into 50% comes to 2 lakh rupees. Therefore, 30,000 plus X equals to 2 lakhs. Therefore, what is the value of X? X equals to 2 lakh rupees minus 30,000. That comes to 1,70,000 rupees is the profit. So, this is another question where you can calculate the value of the profit when the sales volume at 4 lakh rupees. Then you need to find out the effect of break-even point when the selling price is increased or decreased. Let's come to the first one as when selling price is increased by 10%, what is the effect on break-even point? You know that the present sales, existing sales was 1,20,000 rupees. If it is increased by 10%, 10% comes to 12,000. 1,20,000 plus 12, the new selling price comes to 1,32,000. Now, the rest of the things are the same. That means to say the adjustment is pertaining only to the increase in selling price. Therefore, the remaining thing is the new contribution. So, selling price minus variable cost, the variable cost is 60,000 rupees that is given. Therefore, contribution comes to 72,000. So, with this, we need to calculate the break-even point. Straight away, the break-even point can be calculated. That is, break-even point equals to fixed cost divided by contribution into sales. Now, here the adjustment is only pertaining to increase in selling price. The new selling price is 1,32,000. Variable cost that was given in the question was remains unchanged as 60,000. So, 1,32,000 minus 60, new contribution is 72,000. Therefore, fixed cost, it doesn't change at all, that is 30,000 rupees. Now, substituting the values, 30,000 divided by new contribution is 72,000 multiplied by the sales as 1,32,000, you will get the break-even point is 55,000 rupees, break-even sales. So, this is the effect of break-even point when the selling price is increased by 10%. Similarly, if the selling price is decreased, what is the effect on break-even point? When the existing same point, that means to say without any increase or decrease, where the sales was 1,20,000 rupees, break-even point was 60,000. When the sales volume increased by 10%, break-even point has come down. If the selling price is decreased, what is going to be the effect on break-even point? Let us see. The effect of 10% decrease in selling price. Existing sales was 1,20,000. If it is decreased by 10%, 10% comes to 12,000. 1,20,000 minus 10%, the new selling price is 1,08,000 minus variable cost of 60,000. You will get contribution. New contribution is 48,000. Fixed cost the same, 30,000. Substitute the values in the same formula. You will get 30,000 divided by 48,000, that's the new contribution, multiplied by the new sales, 1,08,000, you will get a break-even points of 67,500. So, we need to understand here is, whenever the selling price is increased, your break-even point comes down. When the selling price is decreased, it will shoot up. The break-even point is going to shoot up to 67,500 rupees. So, this is how you need to calculate this effect of either increase or decrease in selling price. The same kind of a thing, it can be calculated even in the tabular form also. The existing is 1,20,000 rupees, the first column, and if the selling price is increased by 10%, there is the second column, and if it is decreased 10%, even this can be calculated in the tabular form also. The same values. It is prepared in the form of marginal cost statement format. Sales minus variable cost 60, contribution minus fixed cost is 30, fixed cost minus contribution minus fixed cost is profit. So, for all the three variants, existing level, if it is increased by 10%, if it is decreased by 10%, what is PV ratio, what is break-even point, what is break-even point in sales also it is calculated. Either you can use the formula fixed cost divided by PV ratio for break-even point in rupees, or fixed cost divided by sales into 100. Directly also you can calculate. This is how you need to calculate this break-even point. So, with this I will conclude. Thanks for watching, and for any kind of a clarification, please mail me back, and thank you so much.